Hey everyone, welcome back to another video. I saw an old article that I thought was pretty interesting considering the date it was released. It was titled, Who Needs Gold When We Have Greenspan? The article was written by Floyd Norris and was released May 4th, 1999. I was 8 years old. I've linked the full article below for your own reading. So previous to this article being written, the UK sold off a large portion of its gold reserves. So when you listen to this story and what happened, and think about the mood and style of articles discussing the state of the economy today, certain types of monetary instruments and investments. And I want to clarify here. I don't have anything against Alan Greenspan. I think he's extremely intelligent and I have a lot of respect for him. Before becoming the chairman of the Federal Reserve, he stated this: the abandonment of the gold standard made it possible for welfare status to use the banking system as a means to an unlimited expansion of credit. In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. There is no safe store of value. Deficit spending is simply a scheme for the hidden confiscation of wealth. Gold stands in the way of this insidious process. It stands as a protector of property rights. If one grasps this, one has no difficulty in understanding the status antagonism towards the gold standard. So it should be noted that while he was chairman of the board of the Federal Reserve, he mentioned nothing about gold. But this is to be expected, as his job was to protect the US dollar and to keep the status quo. Make no mistake, inflation is a form of confiscation in which your past labor hours and time spent is devalued through printing currency, through new forms of modern economic theory. So the article in question was written after the UK sold over 400 tons of gold for $275 per troy ounce. This was done because Gordon Brown, the senior official of the English Treasury, thought gold was a relic of an older age and no longer useful. In spite of this, financial leaders such as Rona O'Connell, head of market analysis for Europe and Asia for FC Stone, is quoted as saying, regardless of the price on any date, gold is negatively correlated with virtually all other asset classes, and from a central banker's point of view, is important in terms of adding international credibility within the financial sector. So let's go over this again. From a banker's point of view, gold is a good hedge against market downturns and volatility. But according to Gordon Brown, gold is a relic. So let's sell it off. That seems like a good idea. He then went on to accidentally leak the fact that England was going to be selling off this massive amount of gold, which further drove down costs. The bank JP Morgan made huge sums of money off of this because at the time they had short trades set up against gold. It should be noted that Gordon Brown, after his time as head of the finances of England, he went on to become the Prime Minister of England. So Norris in his article discusses the process of removing the glitter from gold, and that the greenback or dollar backed by Greenspan is as good as gold. According to him, the dollar is the gold standard of the world. And remember, this is 1999. So it's funny how much that sentiment has changed. You have China, Russia, and India buying gold at record rates. More countries are looking to move away from the US dollar. Yet, in a certain way, in the way this article was written. It would seem as if the US dollar was an untouchable monetary unit, created at the beginning of time, presented to us by God himself. Norris goes on to state that if you had owned stock all of those years, you would have received substantial dividends. If you had owned a lot of gold, you got no dividends, but did have to pay storage fees for the stuff. First off, I'm going to clear this up. If you have gold in your possession, there are no storage fees. You provide the security for it. And yes, he is right. You don't receive dividends on gold. You don't bury it in the ground and it suddenly multiplies. Gold isn't an investment. It is a vehicle in which value is stored. It is an internationally accepted monetary instrument. It is money. Dividends could be the peace of mind you get from physically holding your wealth instead of it being digital zeros in a computer controlled by someone else. Remember what Greenspan said. In the absence of gold, there is no way to protect wealth from confiscation through inflation. Later on in the article, Norris continues, the argument against retaining gold is that its day is past. Once it was useful as a hedge against inflation that would hold its value when paper currencies did not. Now financial markets have their own sophisticated ways, using exotic derivative securities to hedge against inflation. Hold on. Let's hear that again. Exotic derivative securities. You really can't make this up. As hedges against inflation. Well, how has that worked out in the past? Let's go 2020 hindsight here. But over-leveraged securities and asset-backed derivatives were one of the causes of the housing market crash. The financial derivative market today is multiple times the size of the entire global GDP, larger than it was in 2008. If one piece fails, the entire structure could fall apart. So chart. Here's what Norris predicted in his article. If the demonetization of gold continues, the price is likely to keep falling as central bank sales more than offset any increase in demand from jewelers or industrial users. That could change if it turns out that central bankers are not the geniuses they are now deemed to be. But for now, the world believes in Mr. Greenspan and sees little need for gold. Notice in this quote, he only mentions jewelers and industrial uses. No mention of private investors. No mention of other countries holding gold. Here he declares the world, speaking for all of us, believes in Greenspan, and that only use of gold is in jewelry and industrial uses. What he didn't realize was that this was the bottom of a bear market in gold. And next comes the bull market, which culminated in the post-financial crisis highs for both gold and silver. Individuals and nations all over bought up gold and drove the price higher. People, don't jump on a bandwagon. Do your own research and see things for yourself. What is true here is comparing gold to stocks is like comparing apples to oranges. Apples are not oranges, but I love apples and I love oranges. I don't compare them because they're different. Some days I want apples, some days I want oranges, and there's a place on my counter for both. Here at Intellis Independence, we believe that having a well-diversified portfolio is key to maintaining economic freedom and liberty. Gold has been a true reserve asset for thousands of years. It has been a way to hold and maintain dynastic wealth across continents. When you read articles written in such a way as this one, with such surety and such confidence, be warned, lack of hubris and lack of humility destroys many. Do your own research and understand where your money is going, what its value truly is, and how you personally want to carry it into the future. I find the timing of this article just so ironic that in May 1999, a mere 10 months before March 2000, when the dot-com bubble crashed, and that crash didn't stop until just after 9/11. Then, less than 10 years later, the housing market crashed. Now we are again standing on the precipice of a market instability that could turn into the greatest financial crisis of any living American citizen. The value of gold is that it holds its value against the debasement of currencies. The author of the article acknowledged this. He said that the USD was for other countries a hedge against inflation. But what happens as the US continues to debase its currency? Trillions of dollars created out of thin air over the past 10 years, with the majority of the physical cash being held overseas. Countless more dollars have been created in computer systems or as functions of leveraged debt and fractional reserve lending. What happens when all of this begins to flood back, or credit swaps pop due to high risk lending? There are so many issues facing the dollar today. It is, at the end of the day, just a piece of green dyed cotton, and yet millions lust for it and will kill over it. Of course, it's useful for everyday purchases, buying things, paying taxes, but as a store of wealth, I wouldn't bet on it. Nor would I bet on the derivative market protecting my assets from inflation, or anything for that matter. As Greenspan himself said, we can guarantee cash benefits as far out and at whatever size you like, but we cannot guarantee their purchasing power. Knowledge, skills, water, food, land, gold, silver, being debt-free, all lead to financial security. These are the true hedges against inflation, deflation, and economic turmoil. I think Greenspan said it best himself after leaving the Federal Reserve. He said, "Remember what we're looking at. Gold is a currency. It is still, by all evidence, a premier currency that no fiat currency, including the dollar, can match." So the author of the article we mentioned asked the question, who needs gold when we have Alan? Well, from the words of Alan himself, Alan needs gold. So keep seeking, keep stacking, keep learning, find knowledge, and gain wisdom. So, in today's world where they talk about universal basic incomes, where they talk about, oh, well, we can just print money to pay for this. That's modern economic theory. And on paper, it kind of could make sense, but it takes out the human element and the fact that at the end of the day, money is a function of time and labor and the amount of human effort that went into it. Otherwise, there's no real value to it, except for food. I could see food being produced by robots in the future. That could be something that upsets things a bit because that takes care of one of the base needs. But anyways, that's a video for another day. And we'll do a video another day on inflation and how to protect yourself against it and how it affects us and what it really is. I had an interesting experience the other day. I was at a restaurant and I met some guys there and we started talking, and one of them turned out to be the economic advisor of a senator, which was pretty cool. And it's funny because he had a political science degree and I had an economics degree. And I felt like that was kind of ironic. But he was very well educated. He was self-educated in economics. He had read way more books than I have on the subject. And we got to talking, and he said, So you're a full-on Austrian. I've taken aback for a second because I hadn't thought about things in those terms for a while. And I have respect for Keynes. I understand his theories and there's a place for them. But in today's world, we've gone a little bit too far with his. So we'll go in a quick segment on this. Basically, the Austrian economics theory is that any increase in the money supply is inflation. And as I may have mentioned earlier, in my opinion, when you increase the money supply, you basically are decreasing the value of past labor that was set at a certain dollar value in the past. Keynesians believe that only increases in price is inflation. So it's who came first, the chicken or the egg? You increase the amount of money in circulation, over time the prices are going to rise because there's more money going around. Sellers realize this, they can charge higher dollar amounts because more people have more money and are more willing to pay more money when they have it. So a gold standard is almost deflationary in its aspects, and we'll go into that in another video as well. So just some thoughts to think about. Think about articles you read. Think about the tone and mood of those articles and how they present certain topics. So for example, this article was written at the bottom of the gold bear market, basically ridiculing anyone who was thinking of purchasing gold, making it seem as if, the central banks will continue to sell off more and more and more. There's no purpose in buying right now. That would have been the opportune moment to buy because you would have more than quadrupled your money in 10 years. And for an asset that you physically hold, that's pretty good. It's pretty interesting. So thanks for watching. I know this was a long one. Like, share, subscribe. Please comment below. Let me know your thoughts. Have a wonderful day.